Portfolio diversification is a key concept in investment strategy, and it's closely tied to modern portfolio theory, MPT, which was developed by Harry Markowitz in the 1950s. Here's an overview of these concepts. Portfolio diversification. Diversification involves spreading investments across different asset classes or securities to reduce risk. The goal is to create a portfolio where the individual assets have a lower correlation with each other. When one asset performs poorly, others may perform well, helping to offset losses. Diversification can enhance risk-adjusted returns by minimizing the impact of poor-performing assets on the overall portfolio. Modern portfolio theory, MPT. MPT is an investment framework that uses statistical and mathematical methods to optimize the risk-return trade-off in a portfolio. It suggests that investors should not focus solely on the expected returns of individual assets but also consider the correlation between assets. MPT introduces the concept of the efficient frontier, which represents a set of portfolios that offer the highest expected return for a given level of risk or the lowest risk for a given expected return. By diversifying across assets with different risk-return profiles, investors can construct portfolios that lie on the efficient frontier, achieving optimal returns for their risk tolerance. Key principles of MPT include 1. Risk and return. MPT acknowledges that there's a direct relationship between risk and expected return. Higher returns typically come with higher risk. 2. Correlation. MPT emphasizes the importance of selecting assets that are not highly correlated with each other. Assets with low or negative correlations can help reduce overall portfolio risk. 3. Asset allocation. MPT suggests that the allocation of assets within a portfolio is a crucial determinant of its risk and return. It recommends diversifying across different asset classes like stocks, bonds, and cash equivalents. 4. Efficient frontier. This is the set of portfolios that offer the maximum expected return for a given level of risk or the minimum risk for a given expected return. Investors should aim to construct portfolios that lie on the efficient frontier. 5. Risk-free asset. MPT introduces the concept of a risk-free asset, typically represented by government bonds. By adding a risk-free asset to the portfolio, investors can achieve a combination of risky assets and the risk-free asset that suits their risk tolerance. 6. Portfolio optimization. MPT uses mathematical techniques to determine the optimal portfolio allocation that balances risk and return based on an investor's risk preferences. MPT provides a foundation for modern investment strategies, including the use of diversification and asset allocation to build portfolios tailored to investors' goals and risk tolerance. However, it's important to note that MPT has been criticized for assuming that historical data can accurately predict future market behavior and for not fully accounting for behavioral aspects of investing. Nevertheless, it remains a valuable framework for understanding the principles of portfolio construction.